You think you're diversified. You own 15 stocks across 5 sectors, but 3 of them are semiconductor companies, 2 more are cloud software, and your defensive consumer stock gets most of its revenue from a single tech giant. You don't have 15 independent bets, you have 3 big ones, dressed up as 15. Portfolio correlation is the hidden risk that looks like diversification. AI can expose it in minutes. Welcome to the AI portfolio. I'm Abdul, and every episode I give you one practical AI workflow you can use right now to invest smarter. Today, portfolio correlation, specifically 3 prompts that reveal how interconnected your positions actually are and what to do about it. Quick reminder, this is for education only. Not financial advice. Always do your own research. Diversification is only real if your positions are genuinely independent. When everything goes up together, it feels great. When everything goes down together, you realize you are never diversified at all. Correlation measures how closely 2 positions move together. A correlation of 1 means they move in perfect lockstep. 0 means they're independent. -1 means they move in opposite directions. Most retail portfolios have much higher correlation than investors realize. Here's why it matters. In a normal market, your 15 stocks behave differently. But in a crash, exactly when you need protection most, correlations spike. Things that seemed unrelated start moving together. AI can map your exposure before the crash, not after. Before the prompts, let's name the 3 types of hidden overlap. Revenue correlation, 2 companies that both depend on the same customers, platform, or macro trend. Think 2 ad-dependent businesses or 2 oil companies. Factor correlation, 2 stocks that both have high beta, high growth, or high leverage. They look different on the surface but respond to the same market forces. Narrative correlation, stocks tied to the same story. If the AI narrative unwinds, every AI adjacent stock in your portfolio drops together regardless of their fundamentals. Today's prompts identify all 3 types, so you know exactly where your real concentration lives. Prompt 1, Revenue Dependency Map. The goal is to find hidden revenue overlap between your holdings. Give the AI your full list of positions and ask it to identify which companies share major customers, platforms, or revenue drivers. Ask it to flag any pair where one company is a significant customer or supplier of another, and any pair where both companies depend on the same third-party platform, like cloud providers, ad networks, or app stores. The output is a map of revenue dependencies you probably didn't see. One common finding: multiple independent software companies all get most of their growth from the same hyperscaler marketplace. Prompt 2, Volatility-based sizing. Factors are the underlying characteristics that drive stock returns. Things like growth, value, momentum, quality, and beta. Give the AI your list of positions and ask it to estimate each stock's factor profile. Then ask it to highlight which factors are overrepresented across your whole portfolio. A typical finding: investors who think they're diversified across sectors are actually massively concentrated in high growth, high multiple, high beta names. When rates rise or risk appetite drops, the whole portfolio reprices together. This prompt surfaces the hidden tilt. Then you can decide whether you're comfortable with that exposure or whether you want to rebalance toward lower correlation factors. Prompt 3, Narrative Cluster Analysis. This one is qualitative and often the most revealing. Give the AI your full list of holdings. Ask it to group them by investment narrative, not by sector, by story. What is the bull case for each stock? What macro or thematic tailwind does it depend on? Then ask, if this narrative reversed, which positions would be hurt simultaneously? The output clusters your portfolio by shared story. AI boom, rate sensitive growth, China recovery, energy transition, whatever the themes are, you'll see them clearly. This matters because narrative driven sell offs are fast and brutal. When a story breaks, everything in that cluster corrects at once. Here's how to use all three prompts together. Start with the revenue dependency map. This catches the structural links, the actual business relationships, and shared dependencies between your companies. Layer in the factor exposure audit. This identifies the quantitative similarities, the characteristics that make your stocks behave alike even when their businesses look different. Finish with the narrative cluster analysis. This reveals the thematic groupings, the stories that could unwind simultaneously. Together, they give you a three-dimensional picture of your portfolio's real correlation structure. The goal isn't to eliminate all correlation. Some overlap is fine. The goal is to know where it is, so you can decide intentionally, not discover it during a drawdown. Once you've mapped your correlation, you have four options. 1. Do nothing. If the overlap is intentional, you're running a concentrated thesis. Own that decision. Correlation isn't automatically bad. 2. Reduce the most correlated positions. If you have three nearly identical names in the same cluster, consider trimming the weakest conviction. 3. Add an uncorrelated position, something in a different sector, geography, or factor profile. Commodities, international value, or a defensive income stock can reduce portfolio-wide correlation meaningfully. 4. Use correlation to rebalance. When positions drift, winners get larger. Correlation analysis helps you decide which ones to trim first. The AI doesn't tell you what to do. It just makes the decision visible. Your homework: take your current portfolio, even if it's just 5 or 10 stocks, and run all three prompts. Revenue dependencies first, then factor exposure, then narrative clusters. Write down the single biggest overlap you find. Then decide whether it's intentional or accidental. Most investors discover at least one surprise, a stock they thought was uncorrelated. That's actually deeply tied to a theme they're already overexposed to. That's the whole point. Knowing is better than finding out the hard way. Next episode, rebalancing. When to act and how to do it with AI. See you Thursday.